The markets have been manipulated as long as there have been markets. The big boys that control the money can control the markets. It's been happening for a very long time. This is a very important part of our discussion. And for you to understand what our indicators do and how they came about, it's important that we start this whole thing with a discussion about those market manipulators, how they do what they do and why they do it. Many of our indicators were developed after studying actions and reactions in the markets to the market makers' movements inside the markets. In this day and age, market makers move much more quickly and therefore are much more effective than even in years past. If you look at a trading chart, you will see some form of pattern that looks like this. The market makers do the same things over and over and over again. They work very hard at disguising what they do, but they're unable to completely cover their tracks. So the first thing we want to do is understand a little bit more about the workings of smart money or the market makers as they manipulate supply and demand, which we all know is what trading the markets is all about, supply and demand. Thus, with this manipulation, they're able to manipulate price. There are various phases of these manipulations. First phase is what's called accumulation. Then we have a markup phase, a distribution phase, and then a markdown phase. So let's first talk about the characteristics of what is accumulation. It's just exactly what it sounds like. It's when the smart money is acquiring an instrument's assets, all of the available assets that they can purchase. They're going to try to buy them at the lowest price possible. They will typically do this very slowly. They do not want the rest of the market to know or understand what it is that they're doing. So you'll see what appears to be areas of congestion. You and I will call this chop or channeling, where price is apparently trading at a very low volume and it's in a very tight trading range. So you'll see what looks like a lot of sideways action. Okay, this is when the smart money is actually acquiring a large quantity of the asset at the lowest possible price. Okay, and this is very subtle. It's a very sophisticated, sly process of cornering a huge quantity of the stocks or whatever that asset is that make the following phases possible and worthwhile to them. And once a large quantity has been absorbed, the number of floating assets are reduced, then the demand begins to increase. So you can see here that you can see much of the trades are taking place in a real tight range. This is when most of us will be falling asleep, be getting very bored, be wishing we had taken up another profession, because it can be very, very slow and boring, which is exactly what they're expecting. The next phase that these manipulators the smart money will put the markets through will be the markup phase. You'll see a markup phase that's characterized by a series of higher lows and higher highs, or the reverse if they're going in the other direction. Prices will rise on low volume. Price will rise in stages with a series of retracements or pullbacks. Now they're able to do this because volume is very low and the smart money already owns the largest chunk of the available shares. So all they have to do is squeeze down on the distribution of these shares to push price up. Okay, so they know how to do this, they know when to do this, they have the money to do this, and they have the ability, particularly in this day and age with computers, to do it very, very quickly. Now we'll often see a retracement or a pullback immediately after a markup, because this is the short-term traders are often booking profits, okay, or getting stopped out or exiting because of they're being stopped out or the trade is going against them. This markup generally happens much more quickly than the accumulation phase. So the markup will often look like this, where you'll see a markup, then potentially some more accumulation, followed by another markup. They typically will not do it all at once because they're trying to keep people guessing. They're trying to keep us retail traders guessing as to what they're going to do next. Now they're really trying not to tip their hands. Remember I said prices are rising on low volume. High volume tends to get people's attention. All right, but there's an even better way to tell it's being manipulated. We don't have to look at volume. We can look at the speed of the orders coming in. If the orders are coming in faster, then it's likely that the current traders in the market, the current retail traders, could trade that fast. Then this could be characterized as a manipulation by the smart money. Oftentimes you'll hear this, these smart money traders referred to as HFTs, or high frequency traders. They spend millions of dollars on hardware and software to manipulate the markets any way they want. And these manipulations always causes a reaction. Next phase is the distribution. Now distribution is a bit trickier to identify than any of the other phases. Very difficult to determine when it happens. We don't really know and can't really tell because they want this to happen at very low volume. They move very slowly, just as in the accumulation phase. So they don't want to really create a panic. They move very slow. No big moves for sure during the distribution phase. And it will finish with an upthrust bar. As you can see, whoops. As you can see, after an area of distribution, we have these upthrust bars. And the final characteristics of a market manipulation is the markdown. The profits that the market manipulators make happen during the distribution phase. However, when they're finished making their profits, they are still the largest holder of the asset, so they can still manipulate the markets. They will suddenly overwhelm the demand by flooding the markets with all of their assets that they've been holding. When they flood the market with their demand, prices drop faster than many can offload their holdings. So those that bought expecting a breakout start averaging themselves, and this starts causing a more rapid fall in price. So price begins a free fall. It hit bottom, and then what happens? Starts all over again. They do it over and over and over. So in short, we have an area of accumulation where the big money, the smart money, the big boys, the market makers are very slowly and stealthily acquiring all of the available assets. They'll choke down on those assets a bit. There'll be a bit of a markup phase. Then they'll do it again, acquiring some more assets. Choke down, price marks up. This area of distribution is where the smart money makes their money. They bought the majority of the assets down here. They're now selling them up here. When they've hit their goal for this particular manipulation, they're going to clamp down on all sales until it runs price up, and then they'll suddenly dump all of their available assets back on the market, where the sudden burst, a lot of profit takers will jump in. A lot of people who were short will be exiting or getting stopped out, and the markets will have a free fall during the markdown phase. And they will do this over and over and over again. It is our mission as traders to find an edge inside this manipulation.